Hello class, this is chapter 5, Corporate Finance, Accounting 350. We're taking a look at the cost of money. We're looking a little bit more closely at interest rates and what they mean, how they impact. We looked at interest rates in chapter 4. We actually didn't look at it in too much detail. We kind of just looked at it and multiplied by our interest rate. So this is more in depth. Learning outcomes: describe the cost of money and factors that affect the cost of money. Describe how interest rates are determined. Describe a yield curve and discuss how a yield curve might be used to forecast future interest rates. Learning objective 4, discuss how government actions and general business activity affect interest rates. And 5, describe how changes in interest rates returns affect the values of stocks and bonds. So here's realized yield or returns. Yield equals dollar return divided by beginning value, or dollar income plus capital gains divided by beginning value, which also equals dollar income plus ending value minus beginning value divided by beginning value. So I know that's a little bit confusing, but when we start to look at it a little bit more closely, it'll start to make sense. A lot of times these equations make sense when you put numbers in there. So factors that affect the cost of money: production opportunities, time preferences for consumption, risk, and inflation. So these are 4 things that we need to take into account when we look at money. Interest rate levels: interest rates as a function of supply and demand. As you can tell right there, market A, low risk securities, and over on the right, high risk securities. So your risk is higher, your return rates are higher if there's lower risk. Usually you have lower interest, the higher your risk, typically the higher interest rate you will have. For example, if you borrow money like with a credit card or use a credit card, if you have if you're a high risk consumer, you have a higher interest rate, probably above 20%. And if you have better credit and you're lower risk, then your interest rate will be lower. So that's just a little bit more closer example. So interest rates, shaded areas indicate recessionary periods. Down here at the bottom you see inflation, short-term rates, long-term rates. So we're taking a look at these interest rates, and on here it indicates a decrease over time into 1990 all the way until 2014. And keep in mind, these interest rates are kind of going down. Actually, they're not kind of, they are going down. But look at our inflation. So it's kind of keeping up with inflation as well. And as you can tell, look, these are times in blue when there was a recession in 2008. It was longer whenever we had that big bubble, when the bubble burst in the housing market. So it decreased pretty substantially in 2008, 2009. Okay, that was when the U.S. bailed out Wall Street. So rate of return, interest rates, as you can tell, on the y-axis we have return, on the x-axis we have risk, lower risk, higher risk, and then right here premium for risk. And we also have our risk-free rate of return, and that's this shaded area in yellow, and in green is a premium for risk. Okay, so that's definitely something we look at. So the higher risk, the larger the return. And if you take a look at that, typically whenever you have newer companies, you have a higher risk because of the market and people don't really know your company that well. So determinants of market interest rates: rate of return equals R, which equals risk-free rate plus risk premium. So right here we have risk-free rate plus our risk premium. So our risk-free rate plus our DRP, default risk premium, plus our liquidity premium, plus our maturity risk premium. I kind of spelled it out right down here already. Actually, I already talked about it, but it's spelled out right down here at the bottom. Okay, so that's what it looks like. Real versus nominal rates. R equals nominal rate of any investment, which might include a risk premium, RP. R asterisk, the real risk-free rate of return, which does not include inflation. R sub RF equals nominal risk-free rate. So that's RF right here is risk-free, which includes an inflation premium IP that is equal to the average inflation rate expected during the life of the investment. So R of risk-free equals R asterisk plus IP. Okay, so and then if we look at it a little more closely, risk equals R sub R of F plus RP. Okay, so that looks at it a little bit more, kind of looking at it real versus nominal rates. Premiums added to R asterisk for different types of debt: IP, inflation premium, DRP, default risk premium, LP is liquidity premium, MRP, maturity risk premium. And here we take a look at this. Okay, so remember we already looked at this and talked about this a little bit earlier. When we look at this, we'll put some numbers in there here in a bit. Premiums added. So short-term ST Treasury, only IP and initial premium for ST inflation, short-term, and then long-term Treasury initial premium for long-term inflation, and MRP, maturity risk premium. Okay, and then ST corporate short-term initial premium, and then DRP and LP as well. Long-term corporate IP, DRP, MRP, and LP. Okay, so these terms right here, IP, LP, they're spelled out right here. Okay, so I know it sounds a little confusing. The term structure for interest rates. Term structure, the relationship between interest rates or yields and maturities. The yield curve, a graph of the term structure. So the U.S. Treasury bond interest rates on different dates. So term to maturity, 3 months, 5%, 2006, 2007, and then September 2008 at 9%. 1 year, 5.1. So notice the longer you have your money in there, the higher the interest rate. Except for, look at this one. This one decreased a bit right here, and then this one increased right there. So this is the source of the Federal Reserve. U.S. Treasury bond interest rates on different dates. Typically, people say that if you want to, you invest in Treasury bonds if you want minimal risk. Okay, I'm not too sure why they say that. Probably just because Treasury bonds really they don't fail very often. So that's one of the reasons why. So short term, intermediate, long term. Here's our time. Time is always on the x-axis. I'm sure you remember that from algebra. And here's our interest rates, September 08. And so it kind of gained. And then this kind of pretty much stayed steady, about 5%, which is really good, 5% interest. That's better than you'll get on a savings account in a bank. 3 explanations for the shape of the yield curve. Liquidity preference theory. There's also the market segmentation theory, and then there's expectations theory. So these are the 3 we're going to look at. Liquidity preference theory. Everything else equal, investors or lenders prefer short-term securities versus long-term securities because short-term securities are subject to less interest rate risk, thus are more easily bought and sold in the market. As a result, short-term rates should be lower than long-term rates, and the yield curve should be slope upward. Market segment theory. Borrowers and lenders have preferred maturities, generally either short-term or long-term. Slope of yield curve depends on supply and demand for funds in both the long-term and short-term markets. The curve could be flat, upward, or downward sloping. And then expectations theory. Shape of the yield curve depends on investors' expectations about future inflation rates. If inflation is expected to increase, short-term rates will be lower than long-term rates. The yield curve will slope upward, a normal yield curve. If inflation is expected to decrease, short-term rates will be higher than long-term rates. The yield curve will slope downward, an inverted yield curve. Okay, so here's forecasting interest rate. This is the expected theory. Inflation premium IP of n. Inflation period 1, 2, all the way till n divided by n. Okay, so inflation rates expected in year t. So here's expectations theory. Yield percent on an n minus year bond. So R1, R2, all the way to n. Whatever many years we divide by n. Okay. R sub t, 1 year interest rates in year t, which will get R asterisk plus I initial premium sub t, so time. And then this is our discount rate period, and then our long-term premium, I think it was lower premium, and then our MRP as well. So forecasting interest rate examples. So following our chapter is inflation expectations for the next 3 years. Okay, so here's our expected 1 year inflation rate: 2%, 4%, 6%. Expected average inflation rates from January 2 of year 1 to December 31 of indicated year. So 2% divided by 1 equals 2%. 2% plus 4% divided by 2 is 3%. So 2 plus 4 plus 6% equals 4%. So 4% over 3-year period. Average it, basically, is what it's doing. Okay. And here's interest rate. Suppose the risk-free rate, R asterisk, is 3%. So 3% 1 year, 2 year, 3 year, and then 2. So 3 plus 2, 3 plus 3, and 3 plus 4. So our nominal rate. Here's our inflation premium, average expected inflation. And then this will be our rate: 5%, 6%, and 7%, so forth. Other factors that influence interest rate levels: the Federal Reserve policy, federal deficits, international business, foreign trade balance, and business activity. Another thing that's been impacting is, I know whenever you watch the market right now, they say that there's going to be a recession. One of it is because of the election going on right now. So people are a little unsure about who's going to win or who's going to be the Democrat nominee. So keep that in mind as well. So there's all different factors that impact interest rates. Interest rate levels and stock prices: the higher the rate of interest, the lower a firm's profit. Interest rates affect the level of economic activity, and economic activity affects corporate profits as well. So it's twofold, or it goes back and forth. Cost of money as a determinant of value: value of an asset, cash flow of 1, 2, all the way to n, number of years or periods, and then 1 plus r. Here's our growth rate again, to the 1 power to the second, or to the second year, all the way to the n. Okay, if we look at it, here's sum of number of terms divided by t time 1. Okay, so cash flow of t, 1 plus r to the t power. Okay, but that's kind of explained right here as well. Okay, and C of t, the cash flow that the asset is expected to generate in period t. The r is the cost of funds, that required rate of return. So that's chapter 5 in in presentation. If you all have any questions, feel free to email me. I haven't had any emails, just about discussion questions, but other than that, I hope everyone's doing well. Everyone has been submitting their homework and discussion questions. There's just a couple of you that are a bit behind, but for the most part, everybody's doing pretty well. Again, thank you, and have a good day.